So, GE Aerospace. Are they flying a bit too close to the sun on these stellar earnings, or is this high-altitude cruise really just getting started? It kind of boils down to valuation versus validation, doesn't it? Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks.
Hey there, today we're diving deep into GE Aerospace. We're using our research data captured October 21st, 2025, and the backdrop, well, it's pretty conflicted right now. The market's hanging on every Fed clue, caught between this cooling U.S. economy, but then also this potential AI investment boom.
Yeah, it's a confusing picture.
Exactly.
Yeah.
So investors are looking for companies like GE that can, actually deliver strong performance regardless, real results.
Okay, so let's talk about what GE did deliver. They just dropped what some analysts are calling a bombshell, right? Their Q3 results.
Oh yeah, big time.
They smashed expectations, profit, revenue, and importantly, they raised their full-year outlook, pretty much across the board.
And the engine behind it all seems to be that strong, sustained demand in global air travel. It just keeps going.
The street is loving it. What is it, like 87% of Wall Street analysts basically shouting buy or strong buy?
87%.
Yeah.
Which brings us to the real puzzle here. This is where our research gets really interesting regarding valuation.
Okay.
GE is trading, around $306 a share? But our fair value metrics, they're all over the place. Wildly inconsistent.
How inconsistent are we talking?
Well, if you look at earnings per share, the standard accounting metric, the fair value estimate shoots past $383.
Okay, that sounds great. Very bullish.
But then you look at free cash flow, FCF, the actual cash metric.
Uh-oh.
The fair value estimate there is a shocking $167 per share.
Whoa, $167 based on cash flows.
Yeah.
That's basically saying the landing gear might be faulty, even if the plane looks fine mid-flight.
Pretty much.
How can Wall Street keep that 87% buy rating when the pure cash flow math is screaming potential, 50% overvaluation?
It's fascinating, right? It really digs into the mechanics of the aerospace service business. Remember, EPS, that's GAAP accounting. Revenue gets recognized when the service happens or the engine's sold.
Right, the accounting rules.
But FCF, that's the actual cold, hard cash coming into the bank.
Okay.
So this huge gap suggests significant working capital being absorbed. Often happens when they sell these big long-term maintenance contracts up front.
Oh, okay.
But they don't collect all the cash for years down the line. So the accounting performance looks phenomenal. That 383 EPS number reflects it.
But the short-term cash.
Exactly. The short-term cash pressure reflected in that 167 FCF number is kind of being masked, you could say.
Okay, that clarifies the conflict perfectly. Thanks. So given this split picture, what's the market actually doing? How's the sentiment?
Sentiment seems cautiously optimistic is probably the best way to put it. Short sellers, they're barely there. Yeah. Just 1.22% short interest. Very low.
Okay, so not many people betting against it. What about options?
The options market. The put-to-call ratio is 0.95. That confirms a slightly bullish edge, technically.
Slightly bullish. But 0.95 isn't exactly overwhelming confidence, is it?
No, it suggests some hedging is going on. Maybe institutional money is still a little wary of that cash flow risk we just talked about.
Makes sense. And technically, big picture trend.
Oh, the long-term trend is undeniably bullish.
Yeah.
I mean, the price has been on an absolute tear, no question.
My sense of but.
Yeah, but the signals are getting a bit mixed up here at these higher levels. Money flow is still incredibly strong, which suggests, long-term institutional buyers are still committed.
Okay.
However, some other indicators are hinting that the, let's say, conviction behind the immediate buying pressure might be weakening a little.
So momentum might be fading.
It's sort of a classic battle. You've got established momentum fighting signs of maybe underlying rally exhaustion, split signals.
All right, let's wrap this deep dive up then. Given that massive conflict between earnings and cash flow and the mixed signals, what's the strategic outlook from our research? Where do we land?
We land firmly on a cautiously bullish outlook for GE Aerospace right now.
Cautiously bullish. Okay, what are the big risks then?
The primary risks are clearly that 167 SCF overvaluation number we keep coming back to. That's a big one. Plus the mixed short-term momentum we just discussed, and just the general threat of the economy slowing down.
Wait a second. You're leaning bullish, even though our own data is flagging that potentially severe FCF overvaluation. Isn't that like ignoring the engine warning light just because the plane's still flying straight for now?
It kind of is, yes.
Yeah.
But the justification here is powerful, you see. The market doesn't always trade on theoretical fair value alone, especially in short term. It trades on catalysts.
And the Q3 earnings are the catalyst.
Precisely. That stellar Q3 report, the raised guidance, the proof of strong air travel demand, that's such a potent, immediate catalyst right now. Our thinking is that this should overpower both the short-term fatigue signals and, for the immediate future at least, those longer-term FCF concerns.
Okay, so catalyst beats fundamentals for now. What should people watch then? Key levels.
Yeah, for listeners watching this stock, the key battleground for the bulls is definitely clearing that major options resistance level up at $320. They need to break through that ceiling.
And if they fail, where's the point where the bullish idea breaks down?
The critical invalidation level, the point where this whole bullish thesis is really challenged, is down at the option support zone, around $270. If it breaks below that, you'd have to seriously reconsider.
Got it. So it sounds like GE Aerospace got a first-class ticket from its latest earnings report, but maybe its fundamental valuation is kind of stuck back in the baggage hold for now.
That's a good way to put it.
Definitely a flight worth watching, but maybe buckle up for some potential turbulence if that cash flow issue starts to bite down the road.
That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.